The Fed balance sheet number is in. Let me zoom out. I'm kind of giving away the surprise. So, yeah, I mean, the last whole week, Jerome Powell's been testifying to Congress, to Congress, and everyone's, I saw like 100 articles and videos and everything the last week that were saying that the Fed's just going nuts and they're buying bonds like crazy and the QE infinity is never going to stop and the market can't go down because the Fed is blah 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 blah. But instead of listening to what everybody's saying, you can actually just go to the Fed website and look at their balance sheet. And it's hard to see exactly what they're purchasing. I mean, Jerome Powell did say that they're buying mostly treasuries and some mortgage-backed securities, and then they have been buying a tiny amount of bond ETFs. And now this is this is the recession. They went and painted a recession that's like 1 or 2 month recession here. This is pretty funny. Or not even. Like, wait. So it's Feb 5 to Feb 26. The market started crashing on the on Feb 20. So I don't know about this. They painted in a recession that's like a 1 month recession here. And so all good, the recession's over, but they didn't even put it on the right. They didn't even put it on the right month. Like Feb and March is when things actually crash. But okay. Anyway, everybody knows that the Fed balance sheet has been going up, and I doubt very many people have actually looked at it. But in response to the market crash here that started on Feb 20, like they started expanding the balance sheet, and then when the crash really started happening, they started going nuts. And this was an international liquidity squeeze because the international banks weren't lending and couldn't lend. Like the international banking system broke down. So the Fed had to jump in front. That's called the Eurodollar system. That's um, all the dollar loans across the whole world are issued by international banks that issue US dollar loans. And so the Fed has been pretty disconnected from that for a long time. I mean, well, kind of the whole time. And it's been like a 40-year kind of expansion of the Eurodollar system. And that's the huge 40-year everything bubble that we've seen here. And it just kind of, I guess, kind of maxed out and kind of ground to a halt. And so that's what all this is the Fed is jumping in front of the Eurodollar system. They're bailing out the whole Eurodollar system. They're, you know, pumping all this Fed liquidity into the international banks and to the international, like the international private banks that are issuing dollar loans and the central banks. And so I've been trying to figure out, everyone's like, yeah, the Fed's just pumping money into the stock market. And it's not quite that simple. Like over the last 12 years, the way that money was going from the Fed to the stock market was that the Fed um, they create reserve money for the banks, and that doesn't go into the stock market. Then the bank has to turn around and make loans to someone that would put it into the stock market. And the way that it's been going in is they're making loans to these companies that are most of them are not profitable companies, and they make loans. There's low interest loans to these companies, and they use the extra liquidity to do stock buybacks, and that's extra money into the stock market. So over the past 12 years, that is how the stocks have been pushing up and up and up, and there's been less overall stocks available in the market. But when we had this crash, the stock buybacks went way down. Like the only sector that's still doing stock buybacks in any meaningful amount is infotech. And like the small caps and the financials and everything like that have cut their stock buybacks completely out. And yeah, so I mean, I've been looking at it over the past month or two and trying to figure out, watching a bunch of macro videos, like how is the money actually getting into the stock market if the Fed is blowing up the stock market? Which I mean, that's a simple idea that most people agree with, but how's it actually getting into the market? Like it just finds its way into the market. People say stuff like that. I'm like, yeah, okay, but that doesn't really do it for me. Like I need to actually understand how the thing works in order to, base any kind of investment kind of moves on it, or else it's just completely guessing and gambling and stuff like that, which is, I mean, that's what everyone's doing. I mean, I think everyone's just considering the stock market like a casino right now. Um, but I think this balance sheet expansion, the vast majority of this went to the international banks and the international central banks, and you don't get to see exactly who they gave it to, and even Congress can't ask the Fed who they're giving it to. And they've tried. The Congress has tried to ask them, and the Fed's just like, no, we don't have to tell you, and we're not. but but you do get financial reports from the banks, and so the banks have these kind of these safety accounts that they use when the economy is bad to pay for defaults. And so defaults destroy money out of the system. And they've just like had these accounts go way up, like 10x or something, all across Europe. These accounts that they use to basically pay for people that aren't going to pay on their loans. And so, I mean, that money has to be coming from the Fed. Like, where else is that money coming from? And the dollar swap lines, like all the friendly banks that are have good relationships with the Fed, get U.S. dollar swap lines so that they can trade their currency for dollars, and then they can use those dollars to pay their dollar loans. Because like 70% of the world monetary supply is dollars, so everyone across the world owes money in U.S. dollars, but only the U.S. can print dollars, so everyone else has to trade their currency for dollars. And so this is the big dollar kind of short, kind of, like the milkshake theory and things like that, where the dollar should be moving up just because people have to get dollars to pay the dollar loans. Um, but as far as the U.S. stock market goes, if the Fed's pumping a bunch of money over to foreign central banks and stuff like that, why is the U.S. stock market doing so well? I mean, how's that Fed money getting into the U.S. stock market? And so I think over the past couple of months, what's been happening, and you can see the off market trading has been very green, and the actual trading during the day has been relatively flat over that whole bull run over the last couple 3 months or so. The off market trading has been green, and the on market has just, yeah, has been, I guess, a little bit green over the total, but pretty flat. So that looks like a bunch of foreign trading activity going into US markets. And that's where all this Fed liquidity was going over to the foreign banks and things like that. So I think it's foreign, I guess, kind of a flight to safety. I've heard that kind of theory that people are going to US markets and US dollars because their own currencies and their own markets are scary. And the US market, even though it looks bad, looks better than theirs. And the US dollar, even though it might look scary, is less scary than theirs. And so I think that is actually where the Fed liquidity has been going overseas to bail out the whole euro dollar system and reconnect the whole world financial system. And we've kind of switched from a Fed issuing US domestic dollars and international banks issuing euro dollars, which are the international dollars. So now the Fed is kind of stepping in front, and it's sort of the Fed is more central to the whole world system now, just in a few months. So the dollar system has changed already, and so that's kind of a thing to take a look at when trying to figure out the markets. The actual liquidity is really important. So in general, yeah, like if the Fed's expanding the balance sheet, like that's more liquidity that could get into the markets, and usually does, but not always. And this is the thing to look at, is the Fed liquidity is one thing, has stopped. As of 2 weeks ago, it stopped. And as of this week, it's decreasing. Even though everyone's talking about how they're buying like crazy in the bond stuff, that's not what they're doing. Look, just look at it. It's right here. It's going down. And I also wanted to hop over to the treasuries because that's the other side of the equation. Is the Fed, creates liquidity, but the Treasury, when they issue bonds, they're taking liquidity out of the market and they're holding that. And let me show you how the Treasury does it. So this is still the Fed website, and this is the U.S. Treasury General Account. And so the Treasury General Account, it's the TGA. I call it the helicopter general account, because this is for government spending. This gets spent directly into the economy that can be actually circulated as real currency for normal people. Whereas the Fed creates balance sheet stuff, and it goes into the financial system and keeps the banks functioning, and all the derivatives and crazy stuff that goes on behind the scenes with the banks. Like, yes, that can like increase the stock market. It doesn't always have to. And the Treasury general account is taking money out of the system. So like when taxes are collected, it goes into this TGA, and the Treasury general account used to be at normal banks, and it used to be really small. And then in the financial crisis, they switched over to having the Treasury general account at the actual Fed, and it started increasing dramatically. And so now the Treasury has enough money. When they want, they can just spend a mess of money like directly into the economy. And so this is more inflationary money that can actually be spent and circulated. And the Treasury general account has gone absolutely nuts over this expansion. And so this is one place where some Fed printing is definitely going. I mean, it went from 400 billion to 16, it's a trillion and a half now. So, and this, let me go and see if this is decreasing, because this just posted. So this is still increasing. So the Treasury is taking liquidity out of the market, and the Fed is not putting new liquidity. The Fed's actually taking liquidity out of the market from their end too. So this is a liquidity squeeze on the market this week, right now. And if this amount starts going down, the Treasury general account, the helicopter account, when it goes down, it can go down real fast, and they can pump a mess of money into the real economy in a hurry. And this could go to infrastructure bills. This could go to stimulus checks or whatever. I mean, they could pass a bill and just like they could spend $1 trillion into the economy, and that could go into the stock market a little bit. Um, but just the actual liquidity numbers that are coming out now are way different than what everybody thinks they are. Like the savings rate has gone through the roof. Like that's the number one place that everyone's putting their money right now. And the stock market has increased. Like individual people have increased what they're putting into the stock market, but not even close to the amount that they're putting into savings. Just this week, the money market accounts hit a high, like a 30% high. So everybody's moving to cash. I saw a stat that 60, no, it was 30, that was a 30% stat again, that 30% of retired people have sold all of their stocks and moved into some sort of cash or other investments. And so people are just saving a ton of money, and the Congress has been taking money out of the system and holding it. And the Fed has been pumping all this money, well, into the Congress's account and into overseas accounts, it looks like as well. And so I wonder if there's Treasury general account kind of things for other central banks like across the whole world that are all going up, because this went up by like a trillion in the US, but I feel like you look at all the other central banks across the world, if those general accounts are all going way up as the Fed's printing, that might be somewhere where a bunch of this money is actually going. And this gives the Congress and the Treasury basically inflationary firepower. And so I've been looking at the interest rates, and they're not dropping negative right now. It's just kind of steepening a little bit, and it's not negative in the US, but a lot of other countries it's negative. And so I think if the US interest rates go negative, that that's a deflationary thing, and I think this is the firepower that the government has against that kind of deflationary scenario. And so this is a huge thing to watch too. Like you need to know if the Fed balance sheet's going up or down, and right now it's going down, and whether this thing is going up or down, and it's still going up. And if this thing starts dropping, like that's going to be something. Like I don't really know the ramifications of what happens there, but yeah, that's a new thing. Like this is the helicopter account for real. Like they can just drop $1 trillion like in a week or something like that and completely change the domestic money supply and mess with the velocity and things like that. Um, But as for now, this is still going up. This is still taking liquidity out of the markets, and the Fed sheet is coming down and taking liquidity out of the markets. The stock buybacks have continued to slow down and have stopped in most sectors. And now companies are issuing new shares, which is, when companies issue new shares, they take percentage of ownership away from existing shares. So that's called stock dilution, and that's downward pressure. So I think there is a liquidity squeeze in the actual markets now, as opposed to the liquidity squeeze that was just on the international banks that we had before. Just kind of starting now. So yeah, that's the kind of thing for the short and the medium term kind of trading stuff, is trying to figure out the actual liquidity relative to the markets. And we have to look at the whole international system as places where liquidity can come from too, because now it looks like the flow is flowing back away from US markets back into European markets as Europe's starting to reopen and things like that. And it looks like less liquidity here in the short term. And keep a close eye on the Fed balance sheet. If the Fed balance sheet starts blowing up and this thing starts coming down, that's going to mark a big change that we need to look at. But as for right now, it looks like a little liquidity squeeze. It looks like a squeeze on the market, and that should be downward pressure. Let me go see what the market is actually doing. All right, so it did move down. My last video was in this area somewhere. So I'm in South Africa. I went to the safari park yesterday. I saw a lion, which is cool. That's been hard to find lions, but I saw a honey badger in the wild, that's a super super rare thing. We saw hyenas and honey badger yesterday, which was that's pretty crazy. And I couldn't get a picture of the honey badger. He ran across the road and he was kind of like tearing some stuff up behind a bush. um, but yeah, okay. So the market, I was looking at this kind of zone. So we have this, the bull market kind of line here, and we've gone all the way back up to this is the Volmageddon line. So let me just kind of go over the market model. So down here from this liquidation, this is the international monetary system liquidation here, where the Fed started bailing out the euro dollar system, and they did it fast. And this is a one of the biggest moves down in the history of the stock market. And then we swung out into the huge liquidity phase where the Fed's pumping money and everyone's saying it's all going into the stock market. And I don't know. I haven't actually seen a definitive explanation for how it is actually getting into the stock market, if that's the case. But the stock market has been trading up, and I think international liquidity coming into the U.S. market is a decent idea, but then the other markets should be moving down inverse to this market, and that's not what's happened. Like the other markets are following the same pattern as this market, and so I'm not really buying that as an explanation either. But just people that say like, oh, the Fed's printing, so it should go up. Those people should look at the balance sheet and see that the Fed's not printing, and they stopped printing back here, and now the Fed is decreasing the balance sheet. and and so on this bubble model, this top line here this is the bull market support line that goes back to the bottom of the 2018 crash. So this is a 2-year bull market line. And then we have a less steep bull market line that's the 12-year line that goes back to 2008 financial crisis. And so, we crashed and back tested through this Volmageddon line, and then we crashed and back tested through the financial crisis line. And so I thought we were just going to stay down here below this one kind of long term, and we managed to get above this all the way back up to the Volmageddon line and got a massive rejection off the Volmageddon line. So as for right now, this is still a bear market model. This is still the backside of a bubble for my model until we get up here, out of here, and we're using the market support lines as support This is going to be a bear market model that I'll be talking about. And so just on this trading right now, we're not reacting off of one of these major long-term lines. Like we're just reacting along this normal kind of bull line that we've been on for the last couple of months. And so we broke down underneath it and then popped and got pretty good resistance from it here. And yeah, so I wanted to see, it looked like we were going to get a move down here, which we did, but I wanted to see if we're going to actually break down. And we haven't. So right now things are just kind of in a boring area. And so there's a bunch of different things. There's really no momentum in the market indicating any kind of moves right now. All the, the MACD and momentum indicators are kind of in the middle and kind of stalled out. And so there's really nothing going on right now. But in the bubble model, these yellow lines are major. And so back tests off these yellow lines result in big rejections in the bear market case. And then in just the general technicals, this kind of thing here is what people are calling an island top. And so that's kind of a big reversal area. And you can see that the action here is staying below the island top. Which for me, like, this looks like a gap, this looks like a gap, but this doesn't really look like a gap, an island kind of gap. I mean, it looks to me like all these gaps have already been kind of filled. And we're just reacting on the underside of this bull line that we've been following for this, the last couple of months. We've broken down underneath it and we're testing underneath it. And so, yeah, sort of the most obvious kind of high probability thing is to just kind of stay underneath this line and see if we get another rejection off of this line. That would be sort of a double top reversal area under this line. But the more dramatic reversal thing would be to blast all the way back up to the Volmageddon line and get a double top that's terminating like a 2-year tangent line. And so this would be a major thing. Like if we got a reversal off of this line, that would be a huge reversal indicator for a big move down all the way down to the next line, where we get into the whole next phase of this, the backside of the bubble. And so we've already rejected off of this, and it's possible to move down. It's possible to move down from here on this one, and less dramatic. But the action that I'm seeing here isn't indicating that we're going to pop back up to here now. Like as soon as we did this and stuck underneath this line, the odds of that happening went down a whole lot. So I'm expecting this thing to roll over pretty soon, actually. And I think that we're going to get a move past where this stuff happened here. What is this? Is supposed to be my moving average? So it looks like my moving average line is broken. This is definitely not where the moving average is. I'll just get rid of that thing. Yeah, so just on the chart, I mean, there's this zone just in general technicals. There's nothing about this zone that really indicates a direction. The momentum's not indicating much. We're kind of in between a bunch of resistance above and here, and the moving average is here. We're really in the middle of nowhere, in between some really serious support and resistance zones. So the chart itself is not saying much that's useful. But the DXY and like the VIX, I think are much better indicators. And so the dollar is still breaking up. Oh, whoops. And I think this is a big one to take a look at. Here, let's go to a longer term dollar chart. Yeah, so this is all the way out on weekly. So if we go back to this bottom in '08, yeah, this is what the dollar's been doing long term. It's just kind of trending up in this channel, and we're testing the bottom edge of this channel. We got a little breakdown here, and we got a pretty good reversal that we're just looking at now. And so I think the upside potential of the dollar is to cross this channel again and get up above, yeah, get up to 110-ish or something. Maybe not quite that fast, but it does look like the dollar is trying to move up, and there's plenty of room for it to move up right here. And this whole craziness, that happened during the crash and the big dollar move that everyone's talking about is just this little thing here. This is the dollar move that happened during the crash. But if you look at that relative to what the dollar's been doing over the since the financial crisis, the dollar has just been pushing up against other currencies long term, and I think I think that's a trend that's going to be I think that's a trend that's going to be continuing, and we're right along the bottom edge of this thing. And so if we get back into the close trading, I mean not that close. Yeah, so you can see the dollar channel here that I drew. And then you can see this is a pretty highly consolidated reversal point. So I've been pointing at this as looking like a reversal point, and even though this one looked weird, we continued right through that, and we're on this angle here, and it's looking to move up again. So this dollar has been swinging opposite to the stock market for a while, and it's continuing to do that. So this looks like a downward pressure on the market to me. And then the yen started to break down, and now it's kind of chilled, so we're not getting much of a signal from that. But if we look at like the South African rand is a commodity currency. This one's an interesting to take a. Oh, I don't know why the chart looks that ugly. Yeah, so the rand has been breaking down, and it's just kind of stalling out too. Yeah, so the dollar's trying to give a signal. The other currencies really aren't giving much of a signal. And then if we take a look at the VIX has dropped down a little bit again. Okay, this is an interesting one. All right, so here, let's do the VIX. I'm going to throw the VVIX on top of the VIX. All right, so the red one is the VVIX. That's the vol of vol. That's how volatile the VIX chart itself is. I guess it's like a second derivative chart. But I mean, basically, the VIX tells you how big of moves to expect in the stock market, and the VVIX kind of tells you how dangerous the stock market is and how likely it is um, for the volatility to swing a lot, even more. Um, so sort of like acceleration and the size of the moves in the stock market. But it's just generally an indicator of risk in the market. And you can see the VVIX popped way harder than the VIX here, and it's above the VIX now. But if we go back and take a look, like coming into this big blow up in the VIX is when the crash happened. And you can see leading into the crash, the VVIX was above the VIX. And so this is sort of upward pressure on the VIX when the VVIX is above it. And then during the crash, the VIX got ahead and they lined up again. And then the VVIX started pulling down below the VIX again, and it's coming down, it's coming down. And then here we got the VVIX getting above the VIX. And so this is an indicator of kind of higher volatility and a little bit more danger in the market, bear market kind of thing when it swings up, rather than here, where the VIX popped and the VVIX is down. Like that's still pulling the VIX down. But here, this is a reversal indicator, but it swung down below it again, which is interesting. And then here, here we got an increase in both of them while the market was flat, and this was during that island top kind of area where the market was flat, but the volatility was increasing, and then we got this huge blast here. And so this kind of set up it doesn't mean that the VIX is immediately going to break out now. It just increases the odds that the VIX that the VIX will break out, at some point, but it doesn't say when. But this is an interesting thing to watch and see how big the divergence is. And so the VIX is right. The market's trending up a little bit today. The VIX is trending down a little bit today. So this is normal kind of VIX activity. I was pointing at this move here was a bit up while the market wasn't really going up. The market was kind of going sideways. And so I wanted to see if that turned into a move up on the VIX. And so, yeah, the market's just kind of boring today. It's boring, and the VIX is boring. But the VVIX relative to the VIX is not boring right now. It's kind of crazy. And I mean, just here, you can see where they're separate, and it came down a little bit. And they both chilled out. Like the VIX kind of trended sideways, but the VVIX trended way down. So this is something to watch. If if the VVIX starts coming down, then the VIX is less crazy, I guess. Right now the VIX still looks really crazy, and it could pop. And so, like on the way up here, we had like the VVIX above before kind of a big move up, and then they kind of crisscrossed. But I think that's a cool one to look at to try to figure out the volatility in the market. And the VIX is roughly swinging opposite to the S&P. So like today, S&P is up a little, VIX is down a little. So that's pretty, I guess, not really a great indicator either. Let's see if there's anything else that's giving a decent signal. Let me get this thing off of here. Yeah, financials look weak. Small caps. Oh, small caps are kind of pushing up pre-market. Oh, that's an interesting one. Okay, so yeah, these are still kind of trending down, not really doing too much today. The Treasury spread is it's just kind of okay, it's kind of halting. So the yield curve has been steepening a little bit. This is the 5 versus the 30. Let me see what like the 2 and the 10 is doing. So these are the yields on the bonds. So the short ends, like the 3-month Treasury bonds, are close to zero, and then the 30 years have been swinging between like 1 and 2%, and so they've been steepening a little bit. They kind of they hit like a steep point, and now they're a little bit less steep, and they're starting to chill. So if we start seeing the spread flatten out again, that'll be an interesting thing to look at. Like this direction, steepening is more inflationary and a little bit better for financials, and this way is more deflationary and is worse for financials. But you're not getting a signal very as what its direction is trying to go now. So yeah, on the charts, on the technicals, I'm not seeing much of any indicator as to where to go. I mean, there's a bunch of different targets all over the place to the upside and the downside. I mean, we have this bull market line, we have this bull market line that we could hit from the bottom or get on top of, depending on if bullish or bearish case. I still have a bearish model I'm looking to reject off the bottom of one of these. But we've already done that on both of these, so we don't have to hit them again, but we could. And then we have a moving. Let me try to get this moving average back in here. All right, so a lot of people use the 200-day or the 40-week or 50-week. I like to use a 120-day moving average because it swings around a little bit more and it gets more reactions. You can see all these reactions it got here. You can see the reactions it got here. If you zoom in on this, things got pretty wild on this before it popped up. and it's been a pretty good interaction line. And so right now we're on the top of this line, and so this is bull market territory up here, and especially bouncing off of this here is bull market territory, meaning that if you're in a bull market, this moving average will stay below the action and you'll generally bounce up off of it when you hit it, not like directly off of it, but usually if you break it, you'll get a rejection in a bull market scenario. And so this kind of rejection out of here is bullish, but this is, just the first reactions we're getting on it from this side. So if we get continued action in this direction, if we get above these lines, if this line starts swinging up, all of that sort of stuff, that will switch to a bull market model. But as for right now, we're still below, key bubble lines. Like we need to get past all this stuff for me to switch to a bullish model. And this is still on the bear side of the model, but it's up, above this. This is a major thing for the bears to get below, like try to get below this moving average and get below this trend line. And so there's a lot of work to do on the bearish side to try to get back into a bear market model, or back into like a bear market technically, like the bear market technicals. So right now we basically have super bearish fundamentals, and we have bullish technicals, and we have bearish, only slightly bearish, kind of long term model trend lines. Like we're still underneath this one, and so that's still bearish on the long term kind of bubble model. And so it's a really crazy market, and it's super volatile. The VIX is really high. So generally, when the VIX is high, that's a super bearish indicator. But I just wanted to kind of paint a zone of how crazy this area is. So back here, this is Volmageddon. This is when the volatility kicked, and this is when I started getting scared of this whole market and really studying macro a lot more and trying to figure out what the market is doing. And I've been looking a lot at international kind of stuff because I thought the US market was going to get really bad. But it turns out the international markets got way worse than the US market. And now things are just really crazy. So, I mean, just looking at this activity since the volatility has been going crazy, we have this sort of expanded zone here and higher volatility, where this market has the ability to make moves like this across the whole range of this zone. And so, I mean, targets to the upside, like, are up here to all-time highs. Targets to the downside are below the lows. And we're getting this crazy thing here. But just on the bull market model, we have these support lines that have been supporting the bull market, and we've broken down underneath them. And so now we're just underneath this shorter. This is just the 2-year bull market line here, and we're still underneath that. And so that's really the spot that we are right now. We're underneath this line, backtesting it, and looking to see if we break this thing or not. And so if we get above that thing and steady out, then this is the target that I would be looking at. Right now we're below the yellow, and the green line. We're below this bull line and this one. And so that's two major bull lines that we would have to get above in order to get any kind of bullish looking. And we just backtested both of these things pretty hard also. So, I mean, we got a huge rejection off of this one and a pretty big rejection off of this one. Yeah, so I'm expecting a move down here. Just on the bubble model, this looks like a spot to move down. I mean, we already looked like we started to move down, but I'm expecting this thing to turn over. And I was looking at it turning over yesterday, and I wasn't here yesterday, but it has come back up into the kind of boring territory where we are now. Yeah, so we're just still underneath this line. And so, I mean, we can make a little bit bigger move up off of this and still get another, a move like this could reject out of here. And then if we move much higher than that, we're back on this line, which is an even bigger line that you could get a much harder rejection off of. So I think the upside right now in the bullish case, I'm not trying to open any long positions right now because there's just major areas where you could just get rejected hard out of here. And I want to see action away from this, technical area, away from the support lines. Like we need to get above the support lines and use them as support, not be underneath them trying to get through them. And then, in the bearish, we don't really need anything else. Like we already got big rejections here and here. This could move down. This could move down from here. It could move down from the green line. It could move down from the yellow line, and you could get decent sized moves from any of these things. I mean, we just got this, this kind of move. So an equal length move to that would put you below this line, and it's pretty easy to get a longer move than that. Like that's kind of a minimum length move down. So there, I think the downside potential with the VIX up and the liquidity down, I'm just expecting like a downside move soon, but this isn't turning over now. So this move down here didn't follow through, basically. So that kind of drags the timeline out of when it would reverse. And yeah, I don't know if we'll be able to get something crazy by the end of today. I think it's probably going to stay kind of boring today, and we'll have to get a look next week at what kind of shapes we're getting. Now, I guess maybe this. I'm trying to look for for a pattern that sort of makes sense to look out for here. And we got a little bit of a wedge. So you get this kind of swing across here, then you get this rising wedge pattern, and then break and back test, and then back test it again before kind of a follow through that we got last time. And then, I mean, generally a rising wedge kind of pattern only suggests that you're going to move down to the bottom of the wedge. It doesn't suggest some kind of move like this for sure. But where we are, in the major model is we're looking for a reversal pattern that could fall through farther, I guess. And so you get the same kind of thing here. You get a swing across, and we're getting this angle up. So yeah, it could either be a wedge across this trend line or kind of across this trend line. So that would either play out. This kind of angle could play out today. So if we get a rejection around here somewhere, if we reject down out of this thing and back test it, doesn't have to be that far out of it. Any kind of a rejection out of this angle up and a back test could be an indicator that we might move down. Yeah, I like this trend line. Seems to be like the real trend line that we're reacting underneath. So I think this pattern and that goes into next week or something. Like we could see some boring stuff kind of more along here. And then usually like we got two good hits here early, and then what you see quite often is a double tap, a smaller double tap closer together uh, when you reverse out of it. And then usually when you reverse out, you'll back test, and then you can continue down. So just as far as a technical pattern to kind of look out for in the bearish case would be for this kind of double tap here along this area, and then back test and down and move out. But that only indicates a move down to the bottom of the wedge. that doesn't indicate a move like crazy out of here. But it could start a reversal pattern, a bigger reversal pattern. And then as far as Elliott waves go, yeah, I'm trying. I don't see anything like an ending diagonal or anything dramatic in the Elliott waves. I mean, we get this crossover here, which is interesting, but really, this just looks like a flat, and then you generally get like a 1, 2, 3, 4, 5. And so off of the, I mean, you could get like a bearish continuation flat here. So yeah, I don't see any kind of wave counts that look particularly useful in the bearish or the bullish case. But you know, just this kind of pennant shape is more often a bullish. You know, because we came in. This is more often a continuation pattern than a reversal pattern, but it can also be a reversal pattern. Um, Especially in the case, yeah, where you have a long-term trend line like this. And so that's kind of the reversal pattern to look for. But just a generic kind of consolidation thing. If it doesn't break down and it keeps just doing boring stuff, that would start looking more and more bullish, I think. And the fact that this did not follow through here makes it, this looked pretty bearish here, and it did get a move down, but the lack of a follow through on that makes it pretty, I don't know, pretty boring, pretty boring and hard to point at. Oh, here's one that may be interesting. This is the Russell 2000 volatility, and this has swung out into a pennant, which is it's a different look than the other volatility charts. So that has, I don't know, maybe a 60-40 chance of a continuation move soon. Soon, probably. Well, maybe today's trading session it could. Let's see if it breaks out of this on one side or the other. But this kind of pennant shape, when you get a breakout on either side, can indicate a little bit of a bigger move. And the Russell volatility should be pretty similar to the other volatility charts. So this could be one that sort of leads what direction the volatility might go next. So that could be an interesting one to look at. But really, I guess the story for today is that the stock market looks pretty boring and has very few indicators of anything going on. It just looks like to be in kind of a sideways thing. But the Federal Reserve balance sheet is the dead opposite of what people think right now. That thing flattened out 2 weeks ago. Last week it was moving down, and it looks like it's still moving down now. Everybody thinks they're buying stuff up and supporting the market like crazy, blah, 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 blah. That meanwhile, the Congress continues to take liquidity out of the market and increase the Treasury general account. The Fed is decreasing the balance sheet. That's what's actually going on. And that's the liquidity thing. And that's what I think the trading, I think that's the best indicators to use right now for trading is that liquidity measurements. Because the fundamentals just, at some point, the fundamentals will matter. But right now, the trading and the fundamentals are disconnected. And until something changes where they're not disconnected, it's probably not useful to mention like, PE ratios and stuff like that. Yeah, I think what's transportation doing? Yeah, yeah. What about metals? Just kind of sitting there. Tesla's kind of it's at 1,000, just kind of going sideways up there though. Yeah, nothing's really moving right now. So the next time something does something interesting, I'll jump on and let you know. But for right now, it looks like a pretty boring day, and I guess that set up for a big move. Yeah, let me just get back in here and look at this green line because this green line looks like the story for today. Let's get in on a tighter chart and see what this looks like. Yeah, so as far as a flat goes, like an Elliott flat, we're in this zone, and 1, 2, 3, just kind of, I don't know if that's a finished three wave or not, but just kind of a 5 up to this edge of the flat. It looks like a completely normal flat, and if we just get a simple flat, um, it's kind of this area that you would continue to. And so we got this crazy crossover before the flat, and so there's really no indication of what direction this thing is going. But I guess just a bearish setup, if you're looking for a bearish setup, is that kind of rising wedge double tap shape. So if you get a double tap rejection off of this thing, that would be a bearish indicator. And then if you get a back test of the wedge, that could be a bigger bearish indicator. And then as far as a bullish setup, looking to break this, not reject off of it, and then it would probably break and just sort of consolidating above it. That's kind of the shape I would look for probably for bullish, would be like if you break and kind of do a pennant or something shape here, that would be a bullish kind of move with this as a target. So just for something that's less boring for today to sort of look out for, um, it looks like we're moving up a little bit to open here. So we'll see when the actual cash money trading starts, because this is just kind of future stuff that's going on now. But we'll see if we get a continuation on the up move on open. We'll see what kind of action we get along this area, which has been really intense. Actually, this is a bunch of crazy stuff. I mean, this thing is nuts. Yeah, so it could get interesting. Maybe by like midday or something, we have some interesting stuff going on here. So that's sort of the update. Don't listen to what anybody says about the Fed spending. They actually publish their balance sheet. You can go look at it, and you can actually look at the individual purchases, but most everything they're buying is treasuries and some mortgage-backed securities. They're buying very little bonds still, and I don't know if they bought any individual bonds yet. They just have announced that they can buy individual bonds. Um, Balance sheet's going down. It's going down right now. And so it'll be another week before we see a continuation on that pattern. But balance sheet down, Treasury general account up. That's less liquidity on both ends. That's a domestic U.S. liquidity squeeze. And so that is the story for today. Not investment advice, and happy trading.